All right, I'll get started. Hi, my name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, and this is a special FX Street webinar that I'm so happy to be able to give you here today. Today is September 26, 2012. Special day for me. Why? Because it's my now 15-year-old son's birthday, so happy birthday to you, Bobby, here today. Today I'm going, there are my particulars down at the screen. My email address is greg@fxdb.com. My Twitter is GregMikeFX. You can also find me on Forex Live as part of their stream, and also I put web commentary at our website at forexlive.com. Today I'm going to talk to you a little bit about fundamental, systematic, or method trader. Which type of trader are you, and what are the advantages and disadvantages of each? I also hope to be able to go through some charts here today. Needless to say, I'm a technician, so I'll give you a little clue as far as that goes. But we'll go through a little bit of the charts at the end or during the webinar as well here. We'll see how things progress. Before we get started, let me remind everybody that trading foreign exchange is risky. And the disclaimer outlines those risks. Be sure to only use risk capital that you can afford to lose. So be careful with trading. It's a leverage product, so understand all the nuances of it before you go into trading it. Also, this webinar is not intended to give any buy, sell, or hold recommendations. It's purely for educational purposes only, so keep that in mind as we continue on here today. So let's get started. I got this comment from, a guy named AK, okay? It's a few weeks or so ago. And he said this, this is on a commentary page or our commentary page of Forex Live. He said this, hi Greg, do you think any system that, one, defines risk, trades with the trend, 3, has a risk reward of at least 1, that's 1 risk versus 2 rewards, depending upon market conditions, it could be 1 to 3, 1 to 4, etc. Risk 2% of equity per trade. And then he went in and described what he uses: 100, 50, 100, 200 moving average stochastics on the hourly chart. And I back tested the strategy and so on and so forth. You can see his details as far as this. What do you think of this strategy? And it got me thinking about the types of traders and advantages and disadvantages of each. Now, what most people think of when they think of the types of traders is shorter term, swing or intermediate term, or longer term traders. Those are characteristics, and certainly characteristics of types of traders. But there are other types of traders as well, and I thought I would focus on those types of traders in today's discussion, today's webinar, and give my thoughts upon each and the advantages and disadvantages of it, because I do know that in the retail market there's a lot of different types of traders out there. I have my bias. For reasons that I'll try to outline here today, and hopefully, it'll make some sense to you. May cause you to rethink the types of trader that you are, and perhaps in the process make you a better trader as a result. So there are 3 types of traders that I want to focus on here today in the broad aggregate. 1 is a fundamental trader. 2 is a systematic trader, what is called a systematic trader. And 3 I'm going to call a method trader, who follows a method. So let's go through each of these individually and talk about the advantages and disadvantages of each. We'll start off with number 1, the fundamental trader. Characteristics of a fundamental trader include focused on economic releases and trends. A fundamental trader is focused typically on the economic releases and trends. And to give you an idea of what that means, this is a look of just, 12 economic releases. There are more that come out on a monthly basis for the United States. And this is the trends that you see from the graphical interpretation, a graphical view of the most recent, or the last 12 or so events. It actually looks like more than 12, maybe, going back to November of 2010. It's almost 2 years, 2 years of data here. So you can get an idea. From a fundamental trader would look at this data and get an idea as far as what the economy is doing in the United States, and make a judgment as far as maybe the U.S. dollar, what it should do. So before I get into what may or may not happen to the U.S. dollar, what what a fundamental trader would look at is things like the employment report. You might look at the GDP, might look at inflation as represented by CPI, maybe PPI as well, ISM manufacturing index or purchasing managers index, this shows a level of the manufacturing activity. Retail sales is what drives the U.S. economy. What is retail sales doing? Consumer confidence, perhaps a measure of future consumption. If consumers confident, may look to spend more. Things like the trade balance and current account, durable goods orders, those big ticket items that confident consumers might go out and purchase, or it may be a result of things like housing. Buying a house tends to increase durable goods purchases. Industrial production, again, and capacity utilization, measures of manufacturing activity. So that is a snapshot, or this is a snapshot of economic trends within the United States. And typically, if the economic trends are up, the currency of the country should appreciate, ceteris paribus, that's Latin for all things being equal. So if the United States employment situation is, we're adding jobs, the unemployment rate is coming down, not necessarily saying that's the case. Obviously, the Fed is concerned about that, but let's say that we're better off relative to other countries, or that we're seeing home sales, new home sales were a little bit worse than expected here today, but still near higher levels. Existing home sales last week pretty strong. So let's say the trends in the United States are pretty good. Then that currency of the dollar should go higher. Now, what is true, however, in currency pairs is that a currency price is about two countries' economies. So focus should be on one country's strength or weakness versus another country's strength or weakness. So if it's not good enough from a fundamental standpoint or fundamentalist standpoint to just look at, or it should not be good enough to just look at what's going on in the United States. I often get people say, well, the Canadian or the oil inventories, I just got it just a second ago, oil inventories were down, so that should mean higher oil prices and should be good for the Canadian dollar. But it doesn't necessarily mean that the currency, the Canadian dollar, is going to go up. It may be something else that's going on. We'll talk about that in just a second. But the focus becomes is on the two currencies and what they're doing. And so instead of looking at it from the perspective of each individual country, like I looked at in the previous chart with the United States economic data, a fundamentalist might want to look at the employment situation in each of the countries and make a judgment that, okay, employment in the Eurozone is moving higher, employment in the U.S. is trending to the downside, so the dollar should be stronger relative to the euro. That might be one interpretation of what a fundamentalist might look at. Now, the problem is that you have to look at then GDP and look at all the different differences within the GDP and make a judgment of that. You might want to look at the inflation and look at the trends in inflation from one country to another. So there's a lot of fundamental releases and news out there, economic releases that go into determining the value of a currency. Samples of economic releases: GDP, unemployment, CPI, PPI, retail sales, durable goods, industrial production, ISM, consumer confidence, trade balance, building permits, existing home sales, new home sales, budget deficits, auto sales. All these go into this big cauldron, this witch's brew that you call fundamentals. And from that, a fundamentalist would try to make an interpretation of what the dollar should do versus the euro, what the dollar should do versus the pound sterling, what the dollar should do versus the Swiss franc or the Japanese yen, and make a judgment as far as that goes. So there's a lot of stuff, a lot of economic releases that make it very difficult for traders. Now, another thing that fundamental traders focus on, in addition to these economic releases, kind of compounding a problem of a lot, is the focus on events and implications of those events. So what kind of events are there? Well, there's central bank meetings, there's central banker comments, there's change in interest rate policy, there's analyst views, there's downgrades, upgrades of countries, and banks and stuff that go into the value of a currency. There's debt defaults, there's fiscal policy changes, there's elections, there's weather and other natural disasters, there's tragedies like September 11th, assassinations. These things that happen, they affect currency pairs. There's things like war. And all these events that aren't scheduled on your economic calendar, well, some of them are, like central bank meetings, but and we may know that a central bank comment may come out and stuff like that. But these add to the dilemma from a fundamentalist standpoint about what do you want to focus on. Now, add to that even a third characteristic of a fundamental trader, what they may look at to determine value of a currency pair, is things like intermarket influences. The price of oil versus the U.S. dollar and other currencies, the price of gold versus U.S. dollar and other currencies, stocks versus U.S. dollar, commodities versus the U.S. dollar and other currencies. What are their influences on the value of the dollar? And things those relationships or stories from those intermarket relationships, sometimes they work one way, and sometimes they work another way. The story, in other words, the story changes from time to time. So here's a chart of the dollar index, which is the white line, and the S&P index, which is the orange line. And so here we see the S&P moving up, and what's the dollar doing? It's going down. Well, here we see the dollar index moving up and the S&P moving up as well. So this relationship, which was counter here, is now the other way here. And at this point right here, we see the S&P moving up and the dollar moving lower. And what we've seen lately is that's what we've seen lately is this relationship. And so the story can change around, making it even more difficult for fundamentalists. This is a measure of the CRB index or the Commodity Research Bureau index versus the dollar. And you can see that in this period right here, where the CRB or the commodity index, commodities are going sideways, we're seeing the dollar move higher, and that relationship may changes at different points, and so it's not always so simple to fit the story behind the move, and a fundamentalist is concerned about the story behind the move or the potential future move. That's what a fundamentalist does. So what I found is that retail traders in particular tend to love the fundamental stories. Okay, they always want to know. Excuse me, hold on a second. They tend to always they tend to rely on the fundamental story almost as a primary tool. And why? And there are a few reasons why this occurs. And one, it makes traders feel smart. It's a confidence builder. When you know the story behind a move, it makes sense to you. So that's one of the reasons why traders love fundamentals. It gives you that cause and effect relationship between fundamental and price action. In other words, it fits a story to a price move or a potential price move that makes sense. It is a way. It is also a way that we're used to learning how to do something, how to do a task in life. There's always that cause and effect in certain things. When we go to school, we learned about the facts. This is how you calculate something. This is how you do this. This is how you do that. And traders, especially traders who come from other fields, let's say you're engineering or a lawyer or a doctor, not that they don't have similarities to trading, but oftentimes an accountant, oftentimes they're based on, learn this and do this. This is the way that you do it. My wife, is an accountant, and she does things. It's pretty black and white as far as what she does, how she does it. It doesn't make, it takes time to learn all that stuff. And so we as a trader think that, well, the fundamental story is going to determine the value of a currency to the upside, currency pair is to the upside or the downside. And so that's the way you want to trade, is to know the story, to figure out the story, and then trade that story. If you what other reasons why traders love the fundamentals? Because they become an expert. If you give you notoriety. Twitter is great. You get on Twitter, you start to make judgments. You start to sound smart as far as what you're saying, how you're saying it, and you gain a notoriety. And people can also make money from the story if the market and the story are correct. Those are all reasons why we're attracted to fundamentals. Now, there are disadvantages using fundamentalists, and it can as it can make you feel smart, it can also make you feel dumb or not confident, especially when you have this story, this idea behind the story, and it doesn't pan out the way you expect it to do. Now you're very confused, and you start to question the idea about what you're trying to do, and question your thoughts, and you change your thoughts around. It focuses on disadvantages. If you focus on the wrong fundamentals, traders can lose a lot of money. Fundamentals do not define risk or tell traders where they're wrong. And that's probably the most important disadvantage that I see of fundamental analysis, is it doesn't tell you where you're wrong. It doesn't tell you that the Canada yen is going lower. It doesn't tell you when to get out. If you think that the Canada yen, as an example, should be going higher because the Canada economy is stronger, that oil prices, inventories are down, and that the Japanese want a weaker currency, and yet the Canada yen goes down, you don't know when to get out. You don't know when to get out of that trade. So fundamentals do not define risk. They don't tell you when to get wrong. And unfortunately, it's very difficult or impossible to predict. It's hard to predict certain events, events that just happen, things like war or terrorist activity or other things. It's hard to predict employment reports. Very hard to predict what the employment report is going to say. So fundamental traders have a difficult time, an almost impossible time, trying to predict what is going to happen and what the event is going to be. And even if you get the fundamentals right, the market may have already priced the news in. There's no saying that before an employment number, if the market expects a strong number and it comes out strong, that the dollar may not go up, that the dollar may go down. Why? Because the market has already priced in the fundamental news. It can also give you notoriety, again, but the wrong kind of notoriety, negative. If you become, very vocal about your fundamental view, thinking about the people on CNBC who appear there one day and not there the next day. Why? Because they go on there banging the table about their fundamental view about this, that, and the other, and it doesn't pan out. Take the other side, of course, those that go out there, bang the table with their fundamental view and they're right. It goes both ways, but you can gain notoriety the next day. This is an example of the dilemma that fundamental traders have, and I've kind of alluded to it here today. This just came in not too long ago, an hour or so ago. Hi, Greg. Should you help me understand why the Canada yen cannot go higher? Canada economy doing quite well versus other oil inventories full. Bank of Japan wants to step to ease yens. Where can the bottom of this pair be now? This sounds like a trader, perhaps, who is long the Canada yen. Why? Because he sees the fundamental view of the stronger Canada economy. True. He sees that oil inventories fell today. True. He knows that the Bank of Japan wants to do steps to ease yen. True. All of which should point to a higher Canadian dollar versus the dollar yen. But what does it do? It goes below the 200-day moving average. Why? I don't know. Traders may have already priced it in. Oil prices today are still trending to the downside. They may have already priced in the lower inventories. Perhaps the inventories are a temporary thing. I don't know. All those things are the fundamental story that get you as a trader confused. And so for me, if I were to rank the different types of traders, fundamental, systematic, and method, fundamental would be important, but it's not going to be my primary way of determining trading decisions. In fact, I use it as a secondary tool that's supported by being a different type of trader. So let's talk about another type of trader next, and we'll get into the one that I think is most important. There's systematic traders, and systematic traders are what AK was. AK gave me his system. He looks at the 50, he looks at the 100, he looks at the 200 moving average, he looks at the hourly chart, he looks at stochastics, and he has some sort of program there that is designed to tell him be long or short. So what is a systematic trader? A technical trader, first of all, he's not focused on fundamentals at all. He uses tools that are intended to give bullish or bearish trade signals and or overbought or oversold selling conditions. Technical tools, things that relate to charts. Systematic trader technically uses what is called an auto-execute program based on back-tested user-defined rules, sometimes called an expert advisor. Expert advisor is just a series of typed-in program that does that. It automatically executes trades. So that's what a systematic trader does. They are focused on getting their homework done before trading, and then let the program do the rest over 24-hour period, 5.5 days a week. As long as the market's open, they run their program, and it determines buy or sell decisions for them. How easy can that be? You do all your homework beforehand, and then you let the program do the test for you. Can program stop loss levels as well? Most of the time, they're based on rules too, and sometimes the rules can be random, so like a stop 2% of equity or something like that. Nothing wrong with stopping yourself at 2% equity if you're on an entry. But if the market is trending, it doesn't necessarily make sense to me that you stop yourself on 2% equity rule. But nevertheless, what a systematic trader does is does all his homework beforehand, programs a program that's going to tell the system to execute buy or sell decisions for them. Very rigid, very systematic, very disciplined type of way of trading. Now, the advantage of systematic trading: do discretionary work before trading. Let the program do the rest. 24 hours a day, never miss a move. That's one of the advantages. Takes emotion out of trading. There's no fear, no greed that gets involved in the market when it's systematically done. The program does all the trading for you. No need to worry about your emotion. Just let it run. Take discretion out of trading. Discipline, not question. So if you're anxious to get out of a position because of this, that, or the other, because you see some news item, no, you have no discretion in this account. You can define risk and limit risk. You can back test to see expected results, drawdowns. You can give increased confidence to your trading, and there's no fundamental bias. No fundamental bias. So AK came back with a follow-up after I commented to him, and he said that what I like about my system, my systematic trading, is that it has crystal clear set of rules, and it does not leave anything to discretion. So he loves the fact that it's all set. He's done his all homework. It's crystal clear, and there's rules, and there's no discretion. It does everything for him. But now we get into some negatives. The only problem I have, red flag, is when I'm losing on a losing streak. I kind of lose faith in the system, so I have to convince myself that the strategy works by looking at my trade journal stats like risk of ruin, win percentage, return on it, investment, etc. The problem is not that I do not follow the rules. The problem is my psychology when I'm in a losing streak. So here, AK went out and did all his homework with the programming, and he has two lines of yellow where he loves the system, the crystal clear thing, and taking discretion, nothing out of discretion. But his problem is that it doesn't necessarily work all the time, and he has these losing streaks, and then he starts to lose faith in his system, and I have to convince myself. So is emotion out of his trading? Does he still have emotion? Yes. And he's got this temptation, which a lot of people have when they develop systematic tools, is to have it run for a little bit and then go and change it. And so you're actually really just trading discretionary, with discretion every time you go and change your thing because it didn't work that time. So you're going in and changing it. So you're applying that human element into it with the hopes that one day it's going to like half the distance to the goal. You're going to finally get to the point where you're going to get it over the goal line, but you never get there. If you have a penalty on the 5-yard line, it goes to the 2.5. If you have a penalty on the 2.5-yard line, it goes to the 1 3/4. If you have a penalty on if you had a penalty on the 1-inch line, it would go to the half-inch line. So you never quite get there to the finish line. You may get close, you may think you get close, but there's always something that comes up. And this is a problem with systematic trading, is it becomes too rigid. Now, disadvantage of systematic trading: make sure all the parameters are accounted for correctly before turning it on. Many times I've had systems at FXDD. We have these systems go on, and next thing you know, someone's buying and selling, 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 because the system is not programmed correctly. So first thing is if you're going to do a systematic trading, make sure that you program it correctly and that you back test it, not in a live account, that you understand that it's going to work during all market situations. Ironically, fear and greed may not go away. Traders fear their system, not the market. We saw that with AK. Past results do not guarantee future results. Tends to work well in either trend or non-trending markets, but typically not both. The EAs that people, retail traders, typically buy are the ones that many gravitate toward. Typically, the ones geared toward those non-trending environments. Why? Because they're trying to market a system that's right 80% of the time. People like being right 80% of the time. They think they can't go wrong with 80% winners, 20% losers. There's no way that it can go wrong, except when you get in a trending market, and those 20% of the time where it doesn't work right, you end up losing your shirt. Trends are where most of the money is made and lost, folks. Don't forget that. Trends are where the most money is made and lost. That's if you buy an EA system that's worked on non-trending markets, on up and down movements, on scaling in, all this other stuff that goes along with these EAs. Be careful, because in a trending market, you're going to lose your shirt. Seen it time and time again. Systematic traders are limited with the tools you can use. For instance, trend lines are nearly impossible. Fibonacci retracements, at least the way I use them, are difficult to use as well. Mathematically derived tools like moving averages, RSI, stochastics, MACs, are the type of tools that can be used. But I don't know. I use a trend line all the time. Trend lines are very important in technical trading and defining risk and limiting risk and understanding what the trend is. And it's very difficult to program a system using a trend line. If someone out there has one, then or has a program that does it, good for you. But most of them do not. They're concerned about moving averages. That's why most of them have moving averages. Most of them have RSIs and stochastics. Most of them use things like those types of tools that are mathematically derived, where you can take the price over a certain time period, mathematically derive, and say is it above 30 or below 30. If it's below 30, it's oversold. Now buy it. Buy it on when the next bar is up or something like that. Those are the types of systematic. That's the limitation of the systematic tools. You're limited as far as the tools that you can use. Managing trade is somewhat limited. It's hard to manage a trade as proactively as, let's say, a different type of trader. Markets are a discretionary type of trader. Markets behave badly sometimes. They're choppy markets. Discretionary trading is not supposed to be an option. So in certain times, the markets just aren't conducive to these types of systems. And if you have discretion, as an example, you might steer away from trading during these times. Typically, no discretion to adjust for different types of risk. So let's say the unemployment report is coming out. A true systematic trading system would simply trade through the unemployment report, and that may result in as a result of the unemployment rate, you might see risks increase, like not just market risk. We always have market risk, but liquidity risk, event risk, is at a premium, is at a level, it's at a high red level. It's warning, Mr. Smith. Those are times when someone who has discretion would kind of steer away from it. It's kind of a roulette bet, black or red. But a systematic trader will not move away from that. Not minding the store, if trading were so easy, 70% would not lose. So you're not really paying attention to the market. I want to be, in charge of my store. I want to look at the store. No fundamental bias. That may be a drawdown as well. I mentioned earlier that I like to use fundamentals, but as a secondary trading tool. In a true systematic trading system, there's no such thing as fundamentals. Now, the third type of trader, which, as you guessed it, I'm more lean toward, is what I call a method trader. I call a trader that has rules and uses a method trader is a type of trader that has rules and uses rules to their trading, technical rules and tools, but applies a discretion to his trading. They follow the system without the auto execute. So it has characteristics of a system, but it has some discretion during times when discretion is needed. So what does that mean? Well, we'll get into it here in just a second. So advantages of method trader: you do work before trading, so you have to be aware and prepared. There is still a idea of system in it. You have to understand the tools that you're using. You have to understand what you do with the tools after in interpreting that chart. So there is some homework. There is some work ahead of time. It takes most emotion out of trading. There are ways that you can define risk and limit risk and accept risk. And if you do that, if you do these 1, 2, 3, define what I call define risk, limit risk, accept risk, the 3 risks. If you do that, you could take fear out of your trading. You can. If you know that your risk is 12 pips, and that's the limit that you put because there's a moving average line there, there's a trend line there, and you see support against that line, and you define your risk against that level. And if you can define risk and limit risk and then say to yourself, I accept this 12-pip loss, there's no fear. So why do you need to systematically program that? We are humans. We have the ability to control our emotions by defining risk, limiting risk, accepting risk. By the way, you do that too in life, okay? If you're on a golf course and you're looking at a par 3 with water over it, what do traders say? Well, define your risk. The water's over there to the left. Limit your risk. Well, I'm going to play away from the water. and accept your risk, and then be confident in the shot that you make. And if you do that, you'll have more success in your trading. It's kind of in your mind type thing. That's assuming that you're a fairly an okay trader or a golfer. But you can do that in trading. You define risk, limit risk, accept risk, and fear is gone. All right. Can give increased confidence in your trading. Can use visual tools. Tools that many traders can see, like trend lines and Fibonacci retracements. One of the most important things that turned me over to becoming more of a method trader is because I could use things like trend lines and Fibonacci retracements the way that I want to use them, so the way that I think the market uses them, the way that I think lots of traders see them, and as a result, that gives me an advantage. It gives me the ability to see which way the trend is going, which way the trend is not going now as it breaks through a trend line. Most important tool, and it kind of moved me away from systems into methods because I needed those tools. You can scan multiple charts for confluence at key levels. You notice that 8K, he was focused on the hourly chart. I look at the 50-minute, I look at the 100, I look at the 200, and it's on the hourly chart. So that's his scope of analysis. What if you look at a 5-minute or an hourly chart, and you see that the 100-hour moving average is at at a certain price, and you look at the daily chart, and you see that a 38.2% retracement is right at that area as well. To be able to program that is very, very difficult from a systematic standpoint. To be able to see that in a method way of trading is putting the odds of success in your favor. Longer-term traders look at that daily chart, and swing traders look at that hourly chart are going to be looking at the same resistance area or same support area at the same point. It's called confluence. And when you are able to do that as you put the odds of success in your favor. Something should happen at this price because of these reasons, not just one reason or two reasons or whatever, a multiple of reasons that you could see. That is important to me. Can manage winning trades more proactively by using targets. You're able to manage that trade once you get in. Most systems are focused on entry, and the exit may be random. A 2% drawdown from the high, or 30 pip drawdown or trailing stop from the high. That's what systematic traders tend to use. There may be more sophisticated ones, I know, but in a method type trading, you can sit there and say, okay, we moved above the trend line. Now where are we going? We're going to the 100-hour moving average. Now where are we going? We're going to the 38.2% retracement. Now where are we going? We're going to the 200-hour moving average. And you start to proactively manage a trade as it moves up, 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 up. That allows you to stay in the trends longer, make the most amount of money. Can exit with reasons and ride more trends. Can choose not to trade when risk is too great. When you have that unemployment report come out, do you really want to trade that unemployment report? I call it a black and red trade, a roulette type of trade, where it comes out and it could go up or down. I don't know which way it wants to go. Systematic traders don't do that. Fundamental traders might be trying to guess what the fundamentals will be. A method trader can just sit out, wait for the event risk to be over, wait for the liquidity risk to die down, and then trade the market risk like he does every day. That's the importance of having this discretion. We are humans. We do have the ability to control our emotions. We have the ability to put ideas into our head. As long as we keep them simple, as long as we keep the rules simple, I think everything is good with managing discretion using a method. Can anticipate when to trade, can anticipate trends, can recognize different types of markets, can mine the store, watch your own money, can incorporate a fundamental bias as a secondary tool, admitting that trading is not easy, so you have to work harder. You have to add it and mind your risk. Those are the advantages of method trading. We'll go through a method that I like to use in just a second here to end it. Some disadvantages of method trading: discretion can paralyze traders into not trading. So if you have the discretion, some traders out there may not ever get to the point where, even though it's saying buy the market because we went above the moving average, we went above the trend line at the same level, we went above the 38.2% retracement, yet because you're not having the system do it, you can't do it. I cannot teach anyone to trade you have to be able to pull the trigger at some point. So that level of discretion may paralyze traders into not trading. There are ways to get over that by being confident in what you're doing in watching, maybe trading a demo account and seeing that this discretion is actually an advantage to you, that you can actually get to the point where you actually pull the trigger. And if you start to think about defining risk, limit risk, and accepting risk, you're able to do it as well. So but nevertheless, some traders can be paralyzed. Direct discretion can cause traders to break rules, lose discipline. Even though you have the rules in place, because it's not systematically programmed, you may break those rules. So you do have to have that level of discipline in your trading, and you do have to get out when the market says, it's not doing what you thought it should do. At the end of the day, trading is only about what we think the market will do. We cannot actually move the market, so we have to rely on the market actually agreeing with what we think the market will do, whether it's from a technical perspective or a fundamental perspective. So if we're buying against a 100-day moving average and the market goes through that 100-day moving average, we got to sell. And if you don't sell, you're losing your discipline. So you have to have that discipline, but discretion can cause traders to lose that discipline. Discretion can increase traders' fear or greed. Again, there's a way that around that by defining risk and limiting risk. But if you have discretion, you may lose that ability or that systematic way of getting rid of your fear and greed. I do think there is a way around it, but nevertheless, it may be a impact to your trading. You can't trade 24 hours a day. As a result, you can miss valuable trading signals when not trading. That's definitely a disadvantage, and you cannot back test a method because you don't take all the trades. In a discretionary trading environment based on a method, you don't take all the trades. You don't take that trade when the employment number is coming out, right before the employment number is coming out. You just don't. The risk's too great. You don't do that trade. So in theory, you cannot back test it. There may be times when the market is non-trending and it's just coming off a trending market, and you may not want to take the trade because it's in a corrective mode. It's in a non-trend, a potential for a sideways type market, a consolidation type of market, and you may not want to do those trades. So in theory, you can't necessarily back test it. And some people may have a problem with that. Ironically, things like our regulatory agencies, they like to see back testing of trading systems. I think it's kind of foolish, to be honest with you, because not all markets are the same, and as I demonstrated, whatever, it can become impossible to actually get to the right type of systematic trading. Nevertheless, that's what they think. So you can't back test, but you can have an idea that the market is supposed to do this or do that, and if you risk a little, and you have the potential to make more than a little, chances are you're going to make money in your account. Need to think it through. If you don't, and be self-disciplined, you will fail. So you need to understand what your method is. If you don't understand what your method is, you're going to fail. So let's get into some charts here. I hope you have an understanding of the difference between fundamental, systematic, and what I call the method trader. And I'm a method trader. And to give you an idea what a method trader does, particularly myself, from a graphical standpoint, let me put my charts up here. It might be a good idea. All right, you should see my chart, right? Yes. Okay. So this is the euro versus US dollar. I have a few things on this chart. Not many. Don't get alarmed by all the horizontal or the lines that go across these dashed lines. I'll explain them in just a second. But this blue line represents the 100-hour moving average. The green line represents the 200-hour moving average. That's one of the tools I use. That's one of the border lines, if you will, that I use. And then I put in trend lines. And I'm just going to connect lows to lows and highs to highs. And if I can put a parallel trend line, I'll get to that question in a second, Tim. If I can put in a parallel or a line here that cuts across 1, 2, 3, 4 different highs, or gets close to it here, I'm going to go in and put a parallel trend line down at the bottom, connecting a low, and who knows, maybe we'll find some support or some slowing of the market at this level. I also put in Fibonacci retracements. So in this case, I go to the September low. This is our September low price. Came after a consolidation period here. The market's consolidating. This trend started really at this point right here, and also represents the month's low price. So I come down to the September low to the high, and I come up and I use the Fibonacci retracements. Now you also see these horizontal lines coming across the charts, and these horizontal lines represent what I consider key levels that the market will use as support or resistance. They are what I call remembered lines that the market remembers because they were a double low right here. For instance, we had a low right here. The market moved above that level, came down, moved higher, came down, tested that low, moved higher again, and we actually had a double top up here. So this becomes a remembered line up here. So we remembered line up here, remembered line down here. And when the market comes down below that remembered line, the market moves lower. When the market comes back up and tests that remembered line, we got a few pips above that line. The market moved down again. When the market came back up to that remembered line again, we found resistance again. So that level becomes a level of support or resistance. And you can go through, and there are different remembered lines here in the chart. Some of it on this hourly chart are off of lows, like this low right here and these highs right here. Here become a remembered line. This high right here and this high right here become a remembered line, because we had two instances where the market came up to that level and fell off. We have we did this. So we had this support down here. We had low here, low here, low here, here. It doesn't have to be exact. It just has to show some pattern that the market is finding support at those levels. So I'll put those in. Sometimes these horizontal lines that I have on an hourly chart may actually come from, let's say, a daily chart. So if I put the daily chart up here of the euro versus US dollar, and I look back at this low right here, this low comes in at the 129.73. Now, if I come to my my hourly chart, you can't see it here. I'll zoom in here. Actually, came in at 129.74. I'll put a remembered line there at the 129.74. Are we surprised if we go back to the daily chart? We had this low here in the month of February. And that was a rejected low. The market moved sharply to the upside there. That level came in at 129.74. And lo and behold, yesterday, the market, and the day before, the market used that 129.74 as a resistance level. Aha. That's where a method comes into play. You know this low exists back here. You can put it on your hourly chart and have that level in place there and understand that level is a level of resistance. Now, a method trader will also look at that 129.74 and look at this hourly chart and say, look, there's the 100-hour moving average, that blue line in that chart. So yesterday when the price came up and was moving higher in trading up here, moving to the high, moving to that 100-hour moving average, a method trader would take a look at some old low that came back here and rejected a level, visually see that level, and have it as a line going across this chart at the 129.74 level. He would also have the ability of looking at the 100-hour moving average and seeing that it's just a few pips below that level, its simple moving average, and see that it's just below that level. And so is this a level of confluence, a level where a trader can define risk and limit risk against a couple technical levels? Yeah. It is. Now let's go back in time and take a look along this blue line right here and go to the last time the market went to that 100-hour moving average. It happened last Friday when the market did this up and down, volatile type day, just a wild day of movements to the upside, to the downside, and the upside. Is this a normal day? No. But what is normal, or what sticks out about this day? This blue line. This blue line stalled this rally to the upside, and it stalled this rally to the upside. Yes, it went above it. Markets were volatile. Markets were moving fast and directional in a way. So you're going to get those momentum traders who sit there and buy the market above, who are just buying the market and maybe force the market up. But by and large, traders were selling here. Sellers entered the market against that 100-bar moving average. And they may have their stop right up here. They can define their risk against their stop right here against this old high. This high right here may have defined their risk against, just above this old high right here, and this trend line. That was here's a reason to sell. The 100-bar moving average here, the trend line's here, and this old high's here. So a method trader can take their human skills and knowledge and visual, but simple things like your vision. Draw a line, have a moving average in your chart, and just make a judgment as far as my risk is defined by this line right here. I'm going to sell against this trend line or against the 100-bar moving average. I'm going to sell against the 100-bar moving average at 35, or I'm going to sell when the market breaks back below the 100-bar moving average at 35. I don't care what you do. Just there's something about this area right here, and my stop's going to be at 52. So if I sell at 35, and the market goes above 44, I'm going to get nervous. If the market goes above this high, I'm really going to get nervous. I'm going to get out at 50 level. That's out. I'm out. So my risk is 15 pips. Define your risk. Limit your risk. Accept your risk. Fear, gone. Go walk the dog. You, in theory, can do that. Or you might just say, okay, I'm not going to be fooled. This may go flying to the upside here. I don't know. But I do know that if this market does not extend to the upside and fails, this type of activity that I'm seeing here today will likely lead the market further to the downside. I don't know how far it's going to go, but I do know that this market's skittish, and if it fails up here again, the market sees this. I guarantee the market knows where the 100-bar moving average is. Market sees this, and it's going to move down, or the potential to move down. Same thing happened here. The market goes up to that 100-bar moving average. So a method trader knows the rules. I'm using my 100. I'm going to put in some lines across where I think key levels are. Low here, low here, low here. Those are going to be key levels. What's this low right here? This low comes in at 130.03. What does this low come in? 130.10. What does this low come in at? 129.93. Let's go to my hourly chart. 130.10 right here. 129.94 right here. This is a resistance area in the market. It was up on this volatile day right here. What did we hold? We held 130.10 when we started to move to the downside. Am I surprised? No. Market knows that 130.10 level is there. Market knows these levels are here. It sees them. Believe it. Trading is about defining risk and limiting risk. That's it, folks. In a nutshell, that's all it's about. Defining risk and limiting risk. So is life, about defining risk and limiting risk. So anyway, so this is a method or an area where you want to buy the market or sell the market. Of course, you have reasons to trade. Now let's look at today's low. We had this line coming across here on the hourly chart, right? Let's zoom out a little bit here. So we had this high across, and we randomly put a line coming in across here. Well, the market came up, held that line, moved up a little bit, fell below it, failed, moved up again, fell below it again. The market should go lower here. Right? But what do we run into? 50% retracement at 128.35. 50% retracement of the move up from the September low. What else is down here? Let's take a look at the daily chart. Oh, there's a green line there. Up from the September low comes in at 128.35. Now, do you think that there's support in between 23 and 35? Yeah. Do you think there's good support at that level? Yeah. What is a method trader doing? Defining risk, limiting risk against key levels. So, am I surprised that the market found support against this level? No. Does it mean that the market's going to hold support against this level? No. But does it mean that you can define risk and limit risk against this level? Yes. And that, my friends, is what you as a trader, you as a method trader can do. A systematic trader could not program this. They're not going to get it. They are off of trend line. And so anything that uses a trend line is okay. The thing that I have problems with is when the head and shoulders is that people use a head and shoulders and then they measure out the objective and they're tied to that objective. Trading is not about being tied to an objective that's far out. It's about taking steps along the way. In this move right here, we had to get below this low. We had to get below here. We had to get below the 38.2 in this low. We had to get below this low right here. It's all about taking those steps along that way. So that's my feeling about them. So yes, but don't be tied to the objectives. Tell us about two congestion areas on the average chart, 129 and 129.50. I don't have time for it. But but send me an email. I'll send you 129, 129.50. Send me an email and this area right here. You have to be you're patient. We have the 38.2% retracement. We have the 100-bar moving average. Can you get into some trades that don't make sense? But actually, this 129.14 level is kind of the key area here. We stayed below it for most of the time here, moved above it, moved higher, moved below it here, didn't have any closes above it, moved above it here, and then moved up to that level, moved below the 129.14 level, market moved down. So the 129.14 level is my key level, my key technical level, my key method level in my trading. Thank you very much. This is going to be recorded. Thank you to the people of FX Street for allowing me to participate in these webinars. We'll see you next month. My name is Greg Michaelowski, Chief Currency Analyst for FXDD. Good fortune with your trading.